Erin Gibbs, one stock you like over at S&P Investment Advisory Services is CBS. Now, the media player is up around 17% so far this year, which is great, but there's worries about its NFL ratings, which are down. Does that worry you?
No, we still see NFL, particularly in different venues, some of their streaming services being a positive, so the digital, the streaming, as well as them selling off some of their radio assets, making the earnings a little more stable. And it's trading at about 13 times forward earnings, which is really cheap for a media company. So we have it in our portfolios. We really like it. We also see about 18% long-term growth. That's really unusual. So I'm not worried about a few dips in the NFL. This is a good grower.
All right. You are also a fan of Constellation Brands. That's also up around 17% this year. They're selling off their Canadian wines, but they're buying some American whiskey distilleries. So they're buying and selling as well, wheeling and dealing. Why do you like this one?
I think they've been doing a really good job at selling off the lesser players, buying some of the bigger distributions, particularly some of the beer companies. Again, we're looking at like 18 to 19% long-term growth for a consumer staple company. So it is trading a little rich. It's a little higher at 20 times, 4 times earnings. But when you look at the kind of growth that we're seeing, this is definitely one of the areas in that market that we're seeing some growth. Again, something we have in our portfolios that we really love.
Next is Monsanto. Now that stock's trading around $100 a share,
Yep.
and they have a bid on the table from Bayer for, I think it's 128.
Yep.
So will they close the deal?
Right now, it looks unlikely. It looks like the Fed has set up some really big hurdles. It doesn't look like it's going to pass, and they may actually have to pay about $1 billion in not being able to close that deal. However, we still see some really solid growth, even not including the merger, particularly coming out of soybean technology. I know people don't like the word GMOs, but actually Monsanto does them very well. Again, we're looking at about 9% long-term earnings growth over the next year. And I think once the headline risk of the merger goes away, we get back to looking at what the company does well. That's going to be a good play.
All right, and then finally, Aetna. They're also supposed to have a deal with Humana. That doesn't look like it's going to come off due to a lot of political pressure, I would say. So what happens to Aetna after?
So again, Aetna is going to have to pay Humana another big fee for not getting that through. And again, it does look like the regulators may not approve that. That, however, they still have one of the highest medical cost ratios out of any of the healthcare providers. They've got growing margins, growing revenues, even without the merger. And I think most likely they'd probably look at smaller acquisitions that wouldn't get blocked by the regulators to help them with the growth. But the real reason we like it is because of all this headline risk around the merger not happening. It is trading at 13 times earnings, incredibly cheap. It's just such a great value. We really don't see much downside risk. And this is another one we really like in our portfolio.
All right. Thanks a lot for coming on and talking about your favorite stocks, Erin.
Thank you.
And thank you for watching The Street.